Good morning, folks. Hope everyone out there is having a good start to their trading week. Yesterday was pretty crazy for a lot of people, but overall, I think it could be healthy. We might start to see a bit more of a broadening out in this market. After all, equal-weighted NASDAQ outperformed market cap-weighted NASDAQ by almost 3%. Equal-weighted S&P outperformed market cap-weighted S&P by almost 2%. So it is interesting. There was a rotation underneath the surface there. The question is whether that continues. And going into earnings season, we are expecting to start to see the Mag 7 slow a bit and the Inglorious 493 grow more. So there are some signs here that indeed that rotation, that broadening out, could have fundamental support. Stay tuned, folks. We'll be going live in just about 2 minutes. Good morning, good morning, good morning. I hope everyone has had a great trading week so far. Welcome to this week's edition of Back to the Futures with me, Markets and Mayhem. As I was talking about just a little bit earlier, pretty crazy start to the trading week yesterday. Rumors of DeepSeek's R1 model being trained at a small fraction of the cost as to what we've seen others like OpenAI and Google and Microsoft spend on their training regimens. But this is not exactly a one-for-one comparison. It is a 8-point precision model training process versus 32-bit and a lot of the larger models that we've seen, and it's a mixture of experts model, which means it's essentially drawing on other models to train it. So a lot less involved in the training. So not necessarily apples to apples, but nevertheless, we had the reaction that we did, and we're coming into the market in the aftermath thereof on a day in a week where, my goodness, isn't there a lot going on? We've got mega cap earnings. We've got the Federal Reserve decision. We've got GDP, PCE, and we just had two major Treasury note auctions yesterday at $139 billion on offer. One tailed, I believe it was a 5-year that tailed, and the 2-year went okay. Today we have a 7-year note auction in the afternoon. But more to the point, we just had durables. They came in a little bit worse than expected. The forecast was for 0.5%. They came in down 2.2%. We have the Case-Shiller Home Price Index coming in a little bit better than expected, which isn't a great bit of news for the markets because that is more sign of potential inflation in the pipeline. And then coming up at 10 a.m., we have Conference Board Consumer Confidence coming up as well with an expectation of 104. So we do have a very interesting event volatility catalyst jam-packed week ahead of us that is worth paying attention to. So give me 1 second. I'm going to get everything tuned up on my end, and then we will fire this stream off. All right, so first, everyone's favorite slide, the general disclosure. All Bookmap Ltd materials, information, and presentations are for educational purposes only and should not be considered specific advice nor recommendations. And the folks at Bookmap would love for you to join their Discord. There's a lot of great educational content there. There's regular live streams, including myself, every Tuesday at 9 a.m. You can use the QR code on screen or the invite link, discord.com/invite/bookmap. A bit about me. I've been trading for 20 years now. I know that dates me a little bit, but I wouldn't have it any other way. I really enjoy this whole idea of finance, economics, trading price action on multiple time frames, finding ways to pull capital out of the market. And, you know, the idea of trading really being more of a business. And I say that because I hear a lot of folks that are very new to this talk about lottos and Lambos and thinking you can get from $100 to $1 million in your account in a very short amount of time. Maybe a lucky few, and I emphasize the word luck, but most of us really do need to work at it because it really is a business. And I would also say without the hard work behind it, you may not necessarily appreciate the effort that goes into making money and may be more inclined to make poor decisions. So the reason I mention all that is risk management is the number one. That's the most important part of being a successful trader, is managing that risk. Then the second most important part is knowing when not to trade. It's kind of part of risk management, but it's a bit different. Why do I say that? Because we don't need to spend every minute of every day staring at our screens. There are certain environments where we're not wired to trade them. For example, I'd rather trade a trend day than a range day. I feel more comfortable entering and executing in a trend day. I have a better hit rate on those trades, right? And when I go back and I look at my trading journal and I look at the days when I used to trade those range days, I had a lower hit rate than I did on the trend days. So I said, I'm going to focus on trend days, and on range days, I'm going to work on back testing. I'm going to work on analyzing other trading opportunities. I'm going to work on building new software to better improve my awareness of where those opportunities may exist. And that's helped because I see some folks don't burn out on trading because they blow up their account. They blow up on trading because they burn out, because they spend too much time behind the screen. And my point is, you don't have to do that. Right? And some of the things we're going to talk about today may also help you with that exact process, qualifying what is and isn't an environment that's worth trading. So just to date myself even more, I navigated through the great financial crisis, which was a really interesting time. Talk about having the plumbing of the markets laid bare in front of your very eyes. Things were falling apart. There were days where I would come in and it felt like there was no bid on some of the mega cap blue chips like Exxon and Microsoft. Days where the Dow, which was trading around 8,000, would be down 600 points pre-market, which is big, right? And then the Fed would come in, they do an emergency 50 bip cut. That stick save would drive a lower high in markets, but inevitably they'd sell lower until eventually March 2009 came around and FASB suspended mark to market. We got mark to make believe, and all those insolvent banks were magically solvent again. That really was the bottom. The Fed's easing and QE was helpful, but it wasn't enough. Ultimately, we needed to change the rules of the game as it was already being played. So having gone through all of that, I used to be a more discretionary trader. I used to just be charts and heart, right? I'd really go with the gut feel on where I felt the market would go based on the charts. And technical analysis is an art more than a science. So what I tried to do is evolve more and more to the science side, driving my trades based on data. And my approach became more and more systematic, driven by momentum, price action, options flows, sentiment positioning, volume profile, and the big picture. It sounds like a lot, but when you start to add these to models with specific weights, you can automate a lot of the gauging of where the market is, what it looks like, who's in favor, bulls versus bears, and make better informed judgments off the data rather than just lines on a screen. That's not to take away from TA. Technical analysis is a powerful tool in a trader's toolkit, but it maybe shouldn't be the only tool we trade off of. Now, I began working with Bookmap in early 2022 because I saw great value in the way their platform displays market data. I really like the way I'm able to tune into the order flow and see so much on a single screen and yet not be overwhelmed. And that has a lot to do with also how I've tuned up my settings to optimize the way that I use Bookmap. I co-founded TraderAid in 2022. And by the way, this is our third year. We are now celebrating our third anniversary as a company. It's awesome. I'm really excited about 2025. We've got a lot of exciting plans for new tools that we're building, for new content we're generating, for ways we're going to expand our community and our reach in global markets. So stay tuned. I also have a lot of ideas on market opportunities, educational resources, unique market tools like I talked about, and models, and I provide one-on-one coaching. So you're welcome to check out what we do at TraderAid. You can visit our website at traderaid.com, and we do offer a 5-day free trial on our monthly plan, so no commitment. Check us out. Now, why do I watch order flow? This is a really important part of the conversation because I feel like order flow analysis is a way to get under the hood of what's driving price action. And I combine it by looking at order flow in options and futures, particularly when I'm looking at leading stocks in the S&P 500. In fact, I've even built a tool that plugs into Bookmap for the S&P 500 called the SPX Options Visualizer that allows us to analyze those flows in a somewhat automated way. So really, one of the things that you'll see, and you'll probably sense this as a bit of a theme with me if you've been following me, is that I try to lean into technology to automate what is otherwise busy work or redundant work. That's why I created the SPX Options Visualizer. It's why I've created the automated pivot levels that we have and a number of the other tools that we're building and have on the Discord to try to reduce the amount of time that we spend doing busy work and spend more time executing, trading, and learning. So order flow analysis, the key really for me is watching for differentials or what we call deltas. You can see that in the session volume profile. You can see that in the volume bubbles. The reason you're looking at deltas is to find who the aggressor is and whether they're taking control or potentially getting a bit off sides. Either way, you may find opportunity in that flow. I also like to look for large passive order flow in the form of icebergs. Icebergs and to a lesser degree stops are helpful because it gives you a sense as to what these larger players are doing and also some of the orders where they want to hide their size, right? That's the whole point of an iceberg. You're going in and you're hiding your size. So if I'm executing 10,000 S&P 500 contracts, I might iceberg it so I only show 500 on each order, which means that has to go through 20 times before it fills. But why would I only show 500? Because if I show that full size of 10,000, market participants are going to run away from my order. The order book will even algorithmically, automatically run away from my order a bit. You especially see this true in stocks as well, but in enough size, it's true in futures. So understanding where these larger orders, these icebergs are being placed can be helpful because it can give us a sense as to where larger institutions are both interested in taking profits or getting involved with the market, but also that they want to hide some of those footprints a little bit more. Now, why do I use Bookmap to analyze order flow? I've used a lot of different tools, and I started using Bookmap back in 2022, and I really didn't look back. I've Still checked out other tools for order flow, but I always come back to Bookmap because I like how much I can see on a single screen. The powerful visualization capabilities, the customization, the ability to add new features in. I've built plugins for Bookmap where I pull in external data that I algorithmically process and show it right on screen. That simplifies my trading. So I like the flexibility, I like the power, and I like the way it visualizes market liquidity and order flow. Now let's talk a little bit about some of the key SPX levels that we have coming into today. We've got a formidable call wall above us at 6,200. That, if we have a powerful upside reaction, could be a level we could see later this week. And, think of the Fed coming in more dovish than expected, earnings tomorrow being better than expected. Tomorrow is a big day, by the way. We've got what? Microsoft, Meta, Tesla earnings, the Fed. That's a lot in a single day, right? So that's going to be a pretty powerful, potentially volatile day. So be aware the market can move both directions with pretty significant amounts of percentage, gains or losses, in an environment like this where liquidity is lower and where a lot of folks are trying to be on the right side of this tape. Yesterday, you saw panic selling in NVIDIA and Broadcom and a number of other stocks that were just in hedge fund baskets. Nothing really wrong with the companies themselves. I identified 3 really strong opportunities and another one that I'm ready to actually start executing in. So really total of 4 opportunities yesterday. I shared that with the Trader Aid members that were beaten down yesterday that I feel are very attractive. Just waiting for a little bit of signs of reversal. But there are companies sort of like babies getting thrown out with the bathwater and all this that still look good to me. So nevertheless, going back to these key SPX levels, Gamma Flip is at 60.51. So going into today, that does tell us that we are in negative gamma territory by a little bit. Now, it will be interesting to see how this all plays out. It's pretty close to neutral gamma where we are. You can kind of see that on the chart here, the Gamma Flip at 60.51. Pre-market, we're trading at 60.20. So there's not an enormous amount of influence in this negative gamma environment that we're in. But if we get deeper into negative gamma, that can certainly add as another catalyst to increasing volatility, to more chop in this market. The next level to watch is 60.10. You can see there's a bit of a wall of puts up there that could be supportive for price. And then finally, the vol trigger at 6,000. That's a really large level of gross gamma positioning across calls and puts. If we move meaningfully below it, like let's call it 10 points, we're likely to see a pretty significant continuation in selling, but also a very volatile tape. So going into today, I'm still watching 60.59 as a key pivot level. I'd be much more inclined to become much more bullish above that level. And I know it seems a bit far away, but it's really not. If we look at the futures where they're trading right now, we're about 60.54, right? So this is a level where I'd be watching for a move above acceptance. So consolidation above 60.59 for about 5 or 10 minutes to show the market's building acceptance above that level. And then I'd be looking for continuation higher. I would contextualize that with order flow, both what we're seeing in S&P futures and SPX options, as well as the 20-minute opening range. Tuesdays do have over a 60% chance of a double break over the last 6 months. So that tells you can get a head fake lower and still move higher on the opening range and vice versa. So something to keep in mind in the back of our heads. That's one reason I find it very important to look at the opening range as both a sign of where things may be heading, but also to focus on options flow and order flow in S&P futures to confirm. And then the pivot acts as sort of a line in the sand to keep us honest. If we're not above that pivot, I'm still not wanting to take bullish trades. Now, a few exclusive deals, and then we'll dive right into Bookmap. You can get up to 40% off of Bookmap at traderaid.com/bookmap. That's traderaid.com/bookmap. Scroll down to the special offers, and you can see that we have the quarterly and the annual plans with a deep, deep discount. And that's the Global Plus plans, where you're able to get the stops and icebergs on screen as well, which I think is very valuable. If you'd like to check out what we're doing at TraderAid, you can get 20% off by using the code Mayhem20 at checkout. Just visit TraderAid.com, go to our Discord link. When you sign up on WAP, use the code Mayhem20 as your checkout coupon and get 20% off your first month, quarter, or year. Let's dive into Bookmap here. So we can see we're just below that 60.59 pivot. It's not too far from the overnight point of control. There's a lot of buy deltas from that session volume profile just scattered around where we are. So we can see there's been a decent amount of buying, net buying in the overnight session leading into today. And indeed, if we open up where we are, cash session would have us opening up about 0.14% higher on the S&P and 0.12% higher on the NASDAQ. Small cap slipping just a little bit down, 0.08%. And vol slipping this morning as well, with the VIX spot 1740 down 1.21%. Now let's look at the overnight session, and I'm going to visualize it using the filtered view here. So overnight session really range bound. Not a lot to see. We had a nice push higher off the European Open, really gave most of that back, made another push. We saw sellers starting to absorb buyers. Those are those red boxes, that aggressive absorption by sellers. Nevertheless, we still made a push above the point of control, then drag the point of control higher, only to sort of cap out, see some passive selling, and get back closer to the bottom of the range. So we've been in a kind of range-bound environment overnight in the S&P. NASDAQ, a somewhat similar look, although a little bit less constructive. When we're zooming out the NASDAQ, what we can see is we had a nice start, but sellers have been absorbing here from that start of the European Open, and that did have an effect. You can see each absorption indicator we had early on led to selling pressure, right? So these can be pretty good scalp indicators, these absorptions, because what they're telling you is, in this case, sellers are absorbing all of those attempts to pull the market higher and then some, enough to dissuade buyers. So we saw this absorption lead to a 3-candle decline, and this absorption lead to a 3-candle decline as well. It gets a little bit more messy as we get closer to the U.S. market open. We see a bit of a war going on in the tape between buyers and sellers trying to absorb each other. But nevertheless, what has me looking at this a little bit less optimistically than the S&P is we made a new overnight or pre-market low. We did not see that in the S&P 500. If we want to cross compare, you know, we actually saw, and I'll pull this out a little bit more, we saw the opposite. We saw a bit of a higher low, right? So obviously anything can happen after the cash open, but on a relative basis, the S&P looks a little bit better than the NASDAQ this morning. If we're looking at that European and Asian auction. And of course, we do have that event volatility catalyst today at 10 a.m. Conference board, consumer confidence forecast of 104. Any really big deviation there could still cause some short-term market volatility. This is not a hugely important data point, but it is still one worth paying attention to. Now we're going to take a look at some of the commodities contracts, and then we'll get ready for the trading day. Opening bell in just over 8 minutes here. So I'm just looking around at questions right now. Ships asks, good to be here and listen to you. What do you think of Meta? So I think Meta is in a bit of panic mode. I've been tweeting about this a little bit. Apparently they're having now war room meetings with their AI engineers trying to figure out how they can try to catch up with DeepSeek, which is interesting because for one, there's not a lot to catch up to in the sense that this is all open source, so it's all out there. The techniques that were used to make the mixture of experts model and to enhance the amount of efficiency available for training, they're all documented. Moving from 32-bit precision to 8-bit precision, moving to more aggressively optimized training and inference, to use a mixture of experts approach for the R1 reasoning model was another thing that helped to reduce the total training cost because it's essentially using existing models and distilling them rather than large sets of complex data that it has to process. So Meta is kind of telling us with some of the leaks that are coming out that they're playing catch up. I think that the company is very richly valued here. I'm a little bit concerned that Llama, which is backed by such an enormous company, Meta being a mega cap, has had such a hard time really staying as a leading model, really building any kind of discernible moat. And the reason I say that is DeepSeek isn't the start of this. It's just the latest salvo from China. But the reality is Alibaba's Qwen models, QWEN, have also been giving Llama a run for its money for a long time. Like and that's kind of what's funny about yesterday. A lot of this isn't that new. The idea that Chinese companies have been using lower grade NVIDIA GPUs, whether that's true or not, in much smaller size, whether that's true or not, to train models that end up outperforming a lot of the leading US company models, which they are. I mean, I've used them myself, and you can run them on your own computer. You just have to have a decent video card. You can download a tool like Ollama and begin doing inference on your own computer. No reason to share anything with any of these other companies. You can run your own queries locally, right? So that means you can save money on your OpenAI subscription or whatever the subscription you have if you have enough video memory to run a decent model. Now, for me, that means 24 gigabytes of VRAM to be able to run 32 billion parameter models, I should say, that are 4-bit quantized. So that means I can load them all into video memory with a decent context window, run my queries locally. And that's really efficient. And it's also much more secure than sharing, if you're using it for coding or other things that are sensitive, sharing that data with untrusted third parties. So back to the point, what do I think of Meta here? I think there's a lot of risk ahead of earnings, personally, that is a little bit underappreciated. I would, and it does also, I'm just going to pull up a really quick and dirty chart for Meta. It's kind of like at the top of this wedge. So these types of wedge patterns, typically they don't resolve well. So I would be more concerned that this has the potential to resolve lower, but also it's at the top of this range. So here, I personally feel like it's priced to perfection. So I wouldn't necessarily be too interested buying Meta with a forward PE of 26 until we see what they have to say on earnings, what their future plans are for really improving the efficiency of their AI CapEx. Because right now they're very aggressively spending on AI. In fact, leading mega caps are looking at spending about $250 billion this year alone on their AI-related expansion plans. And we may see some changes in those plans. But nevertheless, for now, Meta at 660 for me is a watch and see. On the one hand, of course, there's the bullish scenario that we break above this rising wedge significantly on earnings. Zuck delivers once again, and we have a powerful move that then consolidates and offers some new buying opportunities. But for me, looking at this just very quick and dirty back of the napkin technical analysis, the other side of it is we're seeing resistance here. We're getting into a major event volatility catalyst. I don't personally like playing earnings too much because there's a lot more that we don't know than what we do know, unless we're somehow illegally trading on insider info, which I don't do. So going into earnings, kind of flying blind as to what the reaction could be. Could be up as much as 20% or down as much as 20%. So for me, I would rather watch, see what they have to say, and then if I'm going to play the stock, I'm going to wait a few days after earnings to see the reaction and see what opportunities may exist. If I wanted to be bearish on Meta, I'd need to see the lower side of this rising wedge broken, which would really mean also the 20 and the 50-day broken to the downside, putting the 200-day into view as a potential downside target. That would be my quick and dirty thoughts on it. But Forgive me if I've missed some big details, as there are a lot of moving parts going on right now in this space. Another question, DeepSeek has been out for a bit. Why was it such a big deal yesterday? Yeah, Rando, that's a good question. So R1's been out for like over a week. V3 has been out for over a month. Qwen's been out for even longer, like their most recent Qwen models been out for months and months. All of them were built at a lower cost than OpenAI's O1, than Meta's Llama, than Google's, various models that they have, Gemini and some of the others, and, Claude, and just like all these different AI models have been extremely expensive to train. And yet China is producing powerful models. And by the way, if you don't like the Chinese censorship, which I don't, there are versions of these models that are obliterated with an A rather than an O. You can find on Hugging Face that have removed all the guardrails. So these models know all the stuff they're censored, not supposed to say, but they have these guardrails built in to squelch their output. You can actually get rid of those guardrails with obliteration. And there are folks that remove that and post the updated models onto Hugging Face. So for DeepSeek, for Qwen, for others that are censored by China, you can find the uncensored models too. So that's a pretty powerful resource. You can still ask them all those sensitive questions about the Chinese Communist Party, et cetera, et cetera. So why was it such a big deal, Rando? I think one of the things is we are starting to see the market gain a better appreciation for the risks that are facing NVIDIA. One of them is concentration risk. They have 95% of data center market share. Another is margin compression risk. They have about a 75% margin, down from the high 80s on their Blackwell versus Hopper processors. I am a little concerned that NVIDIA faces three major risks this year. One of them is already starting to play out. So we'll start there. Software-driven efficiency improvements in the AI stack, right? More efficient training regimens, moving from 32-bit precision to 8-bit precision would be one. More efficient inference as well. Caching and other clever techniques can help to improve the speed of inference and reduce the amount of resources necessary. So if you can reduce the resources in training and inference, you don't need as many NVIDIA GPUs. The other issue is that using a GPU to train an AI model is like using a sledgehammer to drive a tack. It's not the best tool for the job. So we're likely to see custom specialized silicon for training and for inference. Amazon's already working on this. Forgive their terrible nomenclature, but they're calling their training chips Trainium, right? So there already are companies building specific use case semiconductors rather than these general purpose GPUs that don't necessarily have the best efficiency for the job. Then there's the third risk, and that's regulatory scrutiny, which we're already starting to see increase out of the EU and to a lesser extent China and the United States. Although under the current administration, I don't think we'll get too much regulatory scrutiny here. But nevertheless, that's a real risk, because if other companies are allowed to enter into the CUDA ecology, that kind of changes the entire dynamic, right? And then we're also seeing really full stack development from AMD. Eventually, AMD will have a suitable competitor to CUDA. I think that's not too far away. So there are a number of risks on the horizon, and it kind of feels like that panic out of NVIDIA and Broadcom and some of the others yesterday was sort of all of that being realized at once. It's like all of a sudden folks kind of woke up from this slumber and said, oh boy, there are a lot more left tails for NVIDIA than we thought. And it kind of all got priced in at the same time. It doesn't mean it's completely priced in, but I think that's part of what drove that sort of stunning realization. Plus the media coverage just went fever pitch. So markets are open now. We're seeing some pressure in the NASDAQ off the open. Taking out the extended hours lows on the NASDAQ with that little move lower. So like we talked about pre-market, the NASDAQ had a bit of a nasty look in the overnight session, making that new low. Now we're making a new lower low in the cash session here. We'll take a look at some of the mega caps driving this price action. S&P also making a new cash session low, but not yet retesting the overnight lows quite yet. We'll see that potentially, though. Those overnight lows actually met up with the put wall. The put wall providing overnight support. How about that? Even in the extending trading session, those options positioning levels that the SPX options visualizer identifies proving to be important. Now you can pick up a copy of the SPX options visualizer and learn more about it by visiting traderaid.com/SPX. I find it to be a rather invaluable tool. Of course, I'm talking my own book. I did make the code and I continue to innovate it, but it is something I use every day that I am trading. So let's take a look at some of the mega cap stocks here. First, Apple. Apple bucking the trend again. It's always interesting. Apple didn't put nearly as much effort into what they're calling Apple Intelligence. Their focus was training smaller models that could fit on your device and then going to a unified memory architecture that allowed local on-device inference of those smaller models. So Apple ended up burning a lot less cash on AI, and they're starting to look a little smarter right now, focusing on efficiency rather than scale. That may be one reason the company is enjoying a bid this morning. Amazon out of the gate, pretty choppy. Definitely making a new cash session high here, seeing some supply overhead, 236, an area where there's 20,000 shares on offer, so that's worth watching, and bouncing right off that point of control. So that does look constructive overall, but I'd say this is consolidation still off the opening bell. We don't have any real decisiveness of yet. Alphabet looking a little less constructive here, making a new cash session low, trading below that point of control. 191.80 and 191 key levels of potential supply to watch. And we also see more interest in lower prices here by a delta of about 465,000 between the bids and the offers on Alphabet. Meta pushing up a little bit higher into that resistance area we talked about on the rising wedge before the market opened. We do have earnings coming out from this company tomorrow after the bell. This is going to be one worth watching closely. Zuck's commentary about what their plans are for AI and really the attempt to throw some water on the fire that DeepSeek started for this AI space. Nevertheless, coming into today, there is a little bit more interest in lower prices or bids. We have a delta of 288,000 now, changing as I speak, for bids versus offers. There's a rather large offer overhead at 675 with 14,889 shares on offer. And we can see buyers are looking a little tired already. Repeated rejections at that daily high of 673 where there's only 1,370 shares on offer. But nevertheless, Meta looking a little more constructive than its peer Alphabet in the open here so far. Microsoft selling off in the open here. Investors probably a little bit concerned about Microsoft's aggressive moves into the AI space and including OpenAI and where that all goes from here, all that CapEx, because Microsoft is still planning to spend an inordinate amount of money building new data centers, and investors are probably wondering, where is that money going to go and how is it going to make a profit in the not too distant future? A question that has made a lot of this CapEx in AI a show me story. So with Microsoft, this is another company where they are showing some weakness off the open, really pulling to a new low, cash session low, pre-market low, seeing a decent amount of bids in the stack here. 431, 7,619 shares on bid, but 430 is a really big level with about 9,499 shares on bid. So worth watching Microsoft here. This is a company that has not really performed very well versus Meta and others. So Meta's actually really had a tremendous run while Microsoft has been trading sideways of late. Netflix really not a whole lot to see off the open here. We'll watch this one as it develops. But right now, just kind of flat to sideways. Their earnings were last week, and they overall delivered on earnings, although their guidance was pretty soft. And I think that was offset by increased share buyback plans and, of course, the plan to increase subscription costs on their customers. And NVIDIA today selling off again this morning, making new lows. This is a company that, again, if a lot of this stuff is to be believed, the demand for their GPUs is likely to be quite a bit lower. Another concern that I have with NVIDIA is Blackwell is not nearly as impressive as it was advertised to be, and it has problems with overheating. And it's significantly more expensive to produce these chips. With smaller and smaller production processes also increase the risk of quantum tunneling, which creates errors that are harder to account for and reconcile. So NVIDIA selling off the open here. And let's just take a quick look at the price action. The company was up as much as 3% pre-market. It's now just about flat. And then finally, Tesla. Tesla also selling off just a bit off the open. Tesla's valuation is pretty wild to me. So I wouldn't be too surprised for this company to take a pretty significant haircut. Technicals are starting to look a bit more bearish. Looks like it's breaking down out of a wedge. And today I'd be really watching that 50-day moving average, which it is testing right now. So if it does start to push below that 50-day moving average, I think we've got quite a bit of room lower on the stock. And then tomorrow's earnings likely to be a bit of a catalyst one way or the other. I would think it's more likely that the stock corrects from here, but we'll see. The one thing that I am looking at is Tesla's forward PE of 120. This stock is not cheap. Let's move back to the S&P futures, making new lows, seeing some iceberg buying. We are pushing below that wall of puts as well. Could make it a bit more likely that we see that vol trigger come into play. Will be interesting to see what the options look like this morning as well. We're looking at yesterday's flow on screen. I keep that there for posterity until today's flow begins to replace it. We should start to see that in the next 5 or 10 minutes. Thanks, Ships. All right, another question coming in. How can we best understand the outside liquidity on Bookmap? Still a bit cloudy on how to use that as an edge. And then also, just this is a little bit more pressing in terms of time. Nomi asks, iceberg buy. Yeah, so below here, we see a 200 contract iceberg buy on S&P futures. That's not a big buy. So I would just look at that more from the perspective of, okay, there's some interest here. They're nibbling at the edges. But for me, I really like to see those buys in the thousands if I'm looking for them as a potential, catalyst for a reversal. And I'm talking about that specifically for the S&P 500. It varies for different futures contracts based on the order book depth. Basically, it's relative to the liquidity in the contract. And we can see that 200 lot iceberg buy not really stopping the S&P from moving to new lows. So in terms of outside liquidity on Bookmap Troutfly, it's a good question. The way that I would look at it is trying to contextualize it within the idea of a market being a three-way auction and understanding where there's supply, where there's demand, and where those imbalances may exist versus there being a balance. So if we see a lot more interest in selling something than buying it, that can potentially give the sellers a bit of an advantage. If the buyers aren't able to show they have supply, then we might see a reversal lower, right? Or we might see a continuation lower, and vice versa if we see a lot more demand than supply. Now, that outside liquidity can be one way that we're able to judge that. Another way is to look at the heat map itself. The inside liquidity sometimes can show that as well. Like if we have a really large zone of offers overhead and the market gets right up to it and then rejects lower, that's telling you buyers don't have the demand to push through there, right? Sometimes that'll happen on what we call death clouds, where there's stacks of hundreds and hundreds of offers, one on top of the other, on top of the other. Price gets right up to it and then rejects lower. That can show you also the same kind of thing. So I would say instead of using it in isolation to try to find an edge, use it as one of many data points and focus on how price reacts in that context. So if you're looking at a stock or a futures contract and that liquidity shows there's a lot more interest in selling than buying, does the price action confirm that? If so, you can have a little bit more confidence. Let me know if that's helpful. Yeah, you're very welcome. Great question. And folks, if you have any questions, please feel free to drop them in the chat. I'm always happy to help. I may not get to them instantly because I'm in 4 different chats and I'm also watching the markets, but I promise I'll look through all the chats and try to get to every question I can. So M. Drury asks a very interesting question. Good morning. With the ability to download DeepSeek, is there a need to get a new iPhone? Did DeepSeek kill the upgrade cycle? So this is just, I'm going to give you kind of a longer explanation on this just to contextualize my ultimate answer. I personally don't find small models very, very useful. I've been self-hosting language learning models on my own workstation for several years to experiment with, mostly for coding purposes. And so, your results may vary for other use cases. But for my own use cases, whether it's like summarizing large volumes of text or, completing code or optimizing code or things like that, I can't say that the really small models that fit on phones are super helpful. They tend to have higher error rates. They tend to be a little less able to sort of infer what you're asking for and provide useful, constructive output. So I would go so far as to say that I'm not very impressed with Apple Intelligence, and I wouldn't upgrade my iPhone on account of what they're doing there, period. I don't have an iPhone anyway, but if I did, that wouldn't be why I'd upgrade, right? I am much more impressed with the larger models. Say the 32 billion parameter models are a pretty sweet spot. You can run them on about 24 gigabytes of virtual memory, or video memory, I'm sorry, big difference there, video memory on your computer as a 4-bit quantized model with enough room to have a decent sized context window. And the context window is where the model might be reading the data you're supplying it or reading back in the conversation you're having with it, so it can kind of keep all of that in top of mind. Now on a phone, you don't have a lot of memory. You don't have a lot of power. You don't have a lot of compute. So it's very limited what you can do with these models. So the short answer is no. It doesn't really change much for the iPhone upgrade cycle unless you like small models and what they're able to provide for very simple, requests and things like that. But I do think it changes a little bit how we may train models and how we may run inference on models. Because what DeepSeek was able to demonstrate is that you can use a lot of the existing models out there to create a mixture of experts model with a smaller floating point from 32-bit to 8-bit to reduce the amount of complexity and compute power and power involved with training and inferring these models. So what it really does is it challenges the status quo thinking that we just need to have unlimited GPUs and that solves all the problems. The reality is now we're in a race for efficiency. It's a bit of a paradigm shift. So I think that's kind of the big takeaway, that this is a paradigm shift. So while I'm talking, we are seeing some stop outs happening in the S&P. We're going to zoom into the price action just a little bit more. Seeing 95 stop outs, 82 more iceberg buys. But this is pretty decisively a lower trend forming here. We haven't yet hit the 20-minute opening range, but already this opening range is about 32 handles on the S&P, which is enormous. That's much bigger than the typical opening range by a factor of about 100%. And we are seeing some of those initial flows coming through with the hot put, the most active strike, about 100 points lower. Now, don't panic. This is probably more hedging flow than anything else, given that we've got the Fed tomorrow, big earnings all week long. We've got GDP, PCE. We've got that 7-year note auction. So there's a lot of reasons to hedge. I don't think that this flow is all just directional bets that's favoring about 90 points lower or so in the S&P. But I do think it's worth watching because this is a market where if we look at positioning aggregates, there's still folks very, very long this market. They've reduced net exposure, but they're still quite long and somewhat complacent even after yesterday. So there is reason to hedge, and hedging does pull liquidity out of the market. It tends to portend to a bit more downside. Let's take a look at Bitcoin here as well. So Bitcoin actually holding up a little bit better today. Yesterday it was very volatile. Today down just about, it's about 0.6%. We'll zoom in just a little bit closer, but very volatile here. And starting to show just a little bit more pressure. Let's check in on the mega caps as well. Apple seeing a little bit of resistance now that we're starting to get into a larger area of supply. There still is more interest in higher prices on Apple by a delta of about 390,000. We're looking at this outside liquidity. So that tells you there still are folks more interested in higher prices than lower prices, and there's a lot of supply right overhead, right? So the onus is on buyers to show they have the demand to push through these offers. So far, we're starting to see just a little bit of a resistance up here, just around 235.50. Amazon chopping sideways, getting closer to the top of its cash session range. We do have a decent sized offer overhead at 236 with 25,000 on offer, so worth watching that level. And Google just stair-stepping lower, pretty clear intraday downtrend on Alphabet shares. Got a large bid down here at 190, worth watching that level. Meta also giving up earlier gains and now making new cash session lows, crossing below the point of control. And again, this is a company where there's more interest in lower prices than higher. Microsoft just kind of trying to get off the mat, flirting with the point of control here. Not a lot of decisiveness, just consolidation in Microsoft so far. Netflix starting to slip lower below the point of control. And we see a decent sized bid down there at 950 with about 3,700 on bid. And NVIDIA, just nasty price action in NVIDIA today. Nothing like yesterday, thank goodness. But certainly seeing a haircut down now, about 0.8%. And looking pretty weak overall. There's a really, really large bid on NVIDIA at 115, worth watching. It's going to put a screenshot of that out there since it's kind of interesting. All right, and let's get to Tesla here. Tesla also making new lows here, just like Google, kind of this stair-step pattern lower, so trending lower on TSLA. Let's take a look at the NASDAQ futures, and we're going to just zoom in a little bit. So trending lower, but trying to stage a bit of a bounce back here. We can see that bid below was pulled. And we starting to see just a little bit more energy to the buy side, but a lot of work for the buyers to do to try to prove themselves here. As we can see, the top of the opening range, just about 100 points higher here. And S&P futures also trying to stage a bit of a recovery as we crossed below the vol trigger, now we're retesting it from below. So checking in on markets, NASDAQ is about break even here with that little pop we just saw. S&P down about 0.13%. Small caps down about 0.25%. And vol back to green now. Spot VIX 1768 up about 0.4%. And in just about 8 minutes, we get consumer confidence from Conference Board. We just take a look around, see if there's any interesting headlines, take a look at the questions, and so forth. OpenAI launches ChatGPT government for U.S. government agencies. How exciting. That's really not a whole lot of other headlines there that are of too much interest outside of the econometrics we went over before the market opened. Remember, outside of consumer confidence, we also get Boeing's earnings call at 10, Lockheed Martin at 11 a.m., 7-year note auction at 1 p.m., and then Starbucks tonight. They will be releasing earnings and a conference call at 5 p.m. And then BOJ will have their meeting minutes at 6:50 p.m. tonight. So going back to questions, Big Deal Donuts asked, is there a link to how to recognize absorption reversals? I've seen some videos, but I think there's more on Tradery that I might have missed. That's a great question. So the absorption indicator that I built for Bookmap is still in beta. I am working on documentation for that, and I plan to have some live streams and documentation in the form of video and written articles coming out this quarter. I do, however, have some documentation about the exhaustion indicator that you can check out on the TraderAid website under the tools section. So look for that, and then I'll post an announcement on our Discord when we have the absorption information all available for everyone. Because my absorption indicator is different than what Bookmap offers. It's a bit more focused on the absorptions of greater magnitude. All right, some more questions. Ships asks, what does the vol trigger mean? So the vol trigger is an area of options positioning. Typically, it's the largest area of gross gamma exposure, so puts and calls, right? You can see that at SPX 6000. And just because I know we're all visual people, let me bring up a chart so I can kind of do a better job illustrating that. So give me one moment. Okay, I'm going to pull this into an image viewer software and then pop it onto the live stream. All right, so here is the current SPX options exposure visualized via gamma, and here's 6,000, right? 6,000 is the vol trigger. So you can see there's an enormous amount of puts and calls, puts on the left, calls on the right, yellow and blue respectively. And so that's a vol trigger because if we move meaningfully below it, it's really likely to start to change some of the dealer hedging dynamics, the behavior of options participants. It tends to create more potential for continuation of the downside, but also a much noisier, choppier tape. So vol trigger is something to watch. We have this on the SPX options visualizer automatically calculated throughout the trading day during regular trading hours in the US session as well. Let me know if that is helpful. And Troutfly says, awesome, thanks for your explanation. You're very welcome. Great question. And Rando asks, what are your expectations, if any, for the Fed tomorrow? I expect that the Fed is going to be less accommodating than what the market wants to hear because they're more concerned about the risks of inflation. And they're also seeing a labor market that is pretty darn resilient in the aggregates. And that's what matters. Look, I'll be the first to say, because I've been consistent about saying this for quite a long time, we're in a K-shaped distribution of economic outcomes. Rich people, powerful companies, they're doing much better than working class people and smaller companies, right? But in the aggregates of data, the economy looks fine. That's not to say there aren't people suffering. I mean, the rural area GDP has been in decline for years. So they're in their own recession in rural America for years, just as a talking point. It's one reason probably that we've seen the political landscape shift as much as we have in the last election. So going into the Fed tomorrow, I don't expect a cut. I expect more language about a pause, and I expect Powell to be a bit more hawkish than the market would like to hear, particularly after recent volatility, because he doesn't really feel he has much of a choice. I don't think Powell wants to have the legacy of Arthur Burns, who was the Fed chair that came in and cut too early because of the threat of a recession and allowed inflation to come back. And then for decades has been chided as sort of like a failure as Fed chair. And Powell seems to really like the legacy of Volcker. So like Volcker or not, Powell seems to want to have his legacy be similar in the sense that he wants to be seen as the man who sort of conquered inflation, but without destroying the economy, right? So I think Powell is, and other Fed chair or other Fed chatter, I should say, has been more hawkish, right? So the other Fed speakers, those that are voters and non-voters, have been more hawkish as well. So I don't expect anything from the Fed in terms of adjustments to quantitative tightening or rates tomorrow. I don't expect any adjustments really for many months. I would be surprised if we get more than one cut this year. Maybe we get two. Fed funds futures are pricing about 40 bips of reductions to start around June or July. So I think tomorrow is going to be more of a day where the Fed comes out and says, look, we're seeing improvement, but not enough for us to continue cutting. We're closer to the neutral rate than what we thought earlier. The economy is more resilient than where we thought it would be at this time, and inflation is stickier than where we'd like to see it for additional cuts. So I think the reaction will be rates can push up a bit again, particularly on the short end, because that's where the Fed's policy influence is most pronounced, and that may negatively impact risk assets like stocks and crypto. That would be my thought. And then also, Fed week tends to be not great for gold unless the Fed comes out dovish, which I see as less likely. It's not impossible, but less likely. So let me know if that's helpful. Yeah, you're very welcome. And so we are seeing a nice little reversal off the lows in S&P futures here, now pulling above the point of control. See just a small amount of open iceberg orders being executed here on the sell side there. Let's take a look at the NASDAQ. NASDAQ punching higher here. Buyers absorbing sellers as well, helping to continue this move to the upside towards the top of today's trading range. And we have consumer confidence out 104.1. 104.1. So that's right in line. Nothing really too exciting there. We also have Richmond Fed Composite Index actual coming in -4 versus a forecast of -10, a bit better than expected. So let's take one last look around the mega caps. Apple towards the top of its trading range here, really one of the standouts once again today. Yesterday it was a big standout. Today it's also a standout in tech. It's up about 2.45%. Meta also a standout, up 1.73%. Salesforce up 1.65%. A lot of other tech flat to down. Amazon pushing towards the top of its trading range, showing some strength here, getting up to that offer at 238, about 27,000 on offer. Alphabet also pushing higher above the point of control here, staging a decent recovery. Meta sort of chopping sideways overall, but still staging a decent gain on the day, up 1.73% ahead of earnings tomorrow. Microsoft staging a nice reversal back up towards the top of the trading range just after 950 and then pushing towards new cash session highs and consolidating. Netflix coming back to its point of control and pushing higher. Nvidia bouncing pretty significantly off of its lows. We also saw another demand zone coming in around 116 with about 438,000 shares on bid. And then Tesla, which made new lows and is now bouncing off those lows, but looking a little tired compared to some of its peers. So folks, if you're interested in picking up a copy of Bookmap at up to 40% off, that's 40% off for your first quarter or year of Global Plus, which includes the icebergs and stops, visit traderaid.com/bookmap. That's traderaid.com/bookmap. And you can get up to 40% off. Just scroll down to the special offers. That's something that I want to get out there because that's an exclusive discount. It's huge. And if you've been interested in checking out Bookmap, but you don't yet have a copy, it's a pretty darn attractive offer. So something that I think folks should consider if you think this is good for your trading. And to be clear, this is something that is really helpful for shorter term traders. Now, if you'd like to check out what we're doing at TraderAid, you can do that. Visit traderaid.com. We have a 20% off offer right now. You can use the coupon code Mayhem20 for 20% off at checkout. That's Mayhem20 at traderaid.com for 20% off your first month, quarter, or year. And then finally, if you'd like to check out the SPX options visualizer or learn more about it, visit traderaid.com/SPX. That's traderaid.com/SPX. I want to thank everyone for tuning in. Always appreciate it. I'll be back next Tuesday at 9 a.m. Eastern for the next episode of Back to the Futures. Talk to you soon.